Usually precious metals are, the stable anchor of your portfolio. But last month, someone basically tied that anchor to a speedboat.
Yeah, a very fast speedboat.
Right. So if you blinked in February, you missed this just historic $300 whiplash in the platinum market. And today, we are jumping into this deep dive on the latest market analysis as of March 2026.
Our mission is to figure out why the paper price of platinum crashed so violently.
While physical coins, I mean, they became practically impossible to find.
The disconnect is just wild.
It really is. So let's decode what this means for you as an investor. Because the volatility was, well, it was staggering.
What's fascinating here is just how extreme the roller coaster actually was.
Yeah.
I mean, in late January, platinum had this massive momentum surging right toward $2,900 an ounce.
That's just huge.
Like, totally huge. But then came this brutal flush. It plummeted like 30 to 35% in just a matter of days.
Wait, it dropped under $2,000 for
Yeah.
just briefly.
Yeah. Briefly under 2,000 before clawing its way back to where we are now, in that $2,300 to $2,400 range.
See, that brings up this massive disconnect. The paper spot price was in free fall. Yet, if you walked into a local coin shop, you couldn't buy anything at that spot price.
Not at all.
Premiums held completely firm, and physical coins were just gone. It's like paper trading is this crowded theater where someone yelled fire, right?
Yeah.
Everyone panicked and rushed the exits at once.
That's a perfect analogy.
While the physical stackers just sat there calmly eating popcorn, the paper deeds crash in value overnight. But there's still a line of people down the street waiting to buy the actual bricks.
Right, because platinum is a much thinner, more reactive market compared to gold. The paper market's mostly these heavily leveraged futures contracts moving at, the speed of light.
So retail investors were chasing that late cycle momentum near 2,900.
Exactly. They were highly leveraged. So once the unwind started, it triggered algorithmic selling, massive margin calls, all of that.
Yeah.
But the physical market relies on the slow, real-world logistics of refining, minting, and shipping.
So it physically cannot react to a sudden 30% paper drop.
No, it just can't.
Okay, so if retail investors were suddenly panic selling those paper contracts, what actually triggered that sell-off in the first place?
Well, we saw a hawkish Federal Reserve signaling higher interest rates, and that drove up bond yields and really strengthened the U.S. dollar.
So because precious metals don't pay a dividend, rising yields suddenly make government bonds look, way more attractive.
Right, which drains the speculative money right out of platinum, and it suffers a double whammy here.
A double whammy.
Yeah, because it's a monetary metal, so it gets hit by those rising interest rates. But it's also heavily tied to industry. So when rates go up, economic growth expectations wobble.
Which historically means less industrial demand.
Exactly.
Okay, so what does this all mean? If industrial demand cuts both ways like that, shouldn't a slowing economy terrify you out of holding platinum altogether?
You'd think so, yeah.
Yeah.
But you're forgetting the supply side.
Oh, right, South Africa and Russia?
Yes. They control over 80% of the world's platinum supply. South Africa is still dealing with major production and power grid issues, and Russian sanctions are still this massive wild card.
So when those two nations sneeze, the global platinum supply chain catches a cold.
Basically, yes. Even if industrial demand softens slightly, there physically just isn't enough metal coming out of the ground to meet the baseline need.
Wow.
Plus, that baseline demand is incredibly sticky.
Because we aren't just talking about jewelry anymore.
No, not at all. It's catalytic converters, hybrid vehicles, and the rapidly growing hydrogen energy sector. That fundamental floor is rock solid.
Which brings us to how smart investors are actually playing this. Right now, gold is priced way above platinum.
Historically very expensive compared to it, yeah.
So investors are looking at that huge value gap and literally making ratio trades, like swapping their expensive gold for cheap platinum.
It's a classic value play. But the main takeaway for anyone listening is that platinum operates as a volatile side stack in your portfolio.
Right, it's an asset you buy in extreme weakness, not a stable place to park your emergency fund.
Exactly. Buy the dips, but expect a bumpy ride.
So February 2026 was essentially a pure stress test. The paper market overheated and reset violently.
But the underlying industrial demand and tight global supply remain completely unchanged.
Right, which leaves you with one final thought to ponder as you look at your own portfolio. Since platinum is historically undervalued compared to gold right now, but deeply tethered to future industrial tech like hydrogen,
Yeah.
at what point will its industrial necessity permanently redefine how we value it as a precious metal?